So what do I do during a market crash or a downturn? Well, very first thing, stay calm, don't panic. If you have a clear mind, you generally make better decisions. If you start to panic, that's when people lose a lot more money. There's 27 corrections of 10% or more. Only 6 of them have become bear markets. A bear market is when you have a loss of 20% or more, and that's since 1974. Bear markets last on average about 14 months, and they take about 2 years to recover from. The vast majority of market corrections are minus 10% or more. They end up at about minus 14%, and they usually recover within the same year. Bear markets, on the other hand, take about 2 years on average to recover. The other thing is, if we did enter a recession, about 90% of people stay employed during the recessions, and recessions tend to last on average about 10 months. 2, ask yourself, has anything fundamentally changed? Are any of the companies that you're invested in, basically, do they have stable revenue or income? Is the job market looking good, or is all of a sudden you see hundreds of thousands of jobs being lost? Are they facing any legal issues? Are there any lawsuits brought against those companies, and maybe that's the issue, or there was a major accident that they were responsible for? So if none of those things seem to have fundamentally changed, I'm probably not going to change too much in terms of what I'm invested in. Now, you're going to also want to look, are any of these underlying assets in trouble? Or are they just on sale? Think about this. My house, just like a business, it goes up and down in value every month. If there's nothing wrong with my house and I still have to live somewhere, I wouldn't sell it just because it changes a little bit month to month in terms of what somebody's willing to pay for it. Same thing goes with my businesses. I wouldn't sell off, say, my YouTube business or my farm or anything like that, even though I could have differences in revenue from month to month, year to year. Ginseng might go up, might go down, but overall, I'm not going to just sell it off. Same thing goes with a business that's stock. Effectively, you own a business. I'm not going to change that as long as the underlying business is not in trouble, it's not getting some type of legal issues, it's still bringing in revenue. So I'm going to hold it for a long period of time as long as that still aligns with my long-term goals. The other one is stick with your plan effectively. As long as it still aligns with whatever your goals are and your risk tolerance, I wouldn't really change too much. I still use dollar cost averaging, even though stocks are going down. I'm buying primarily the S&P 500, a little bit in international stocks, a little bit in bonds, and a lot of cash equivalents as well. But I'm using dollar cost average, so as I'm investing in the S&P 500 as it's going down, or international funds as they're going down, I'm just getting more shares of whatever that is. One of the worst things I could do is try to emotionally make decisions. Go, oh no, it's down 10%, and then sell everything off as soon as now it's starting to turn back potentially. So I don't want to basically panic sell, and I don't really want to time the market with the large majority of my stocks and investments, because statistically it doesn't turn out too well. So the thing that's good about market corrections and downturns, you have opportunities. Basically everything's on sale. And if you ever heard, don't throw the baby out with the bathwater, basically you have good stocks that are being thrown out and put on sale. Same with all the bad stocks, because people are just panicking at that point. So if you take a look, you can actually find good stocks that are still profitable to purchase during that period of time. Generally, I just stick with the S&P 500. It rebalances every 3 months, and if something's not profitable, it basically gets kicked out and replaced. And then the bad stocks, effectively, they have fundamental changes. Basically, they live on debt. That's basically the bathwater. That's the baby. So you want to get rid of the bad and retain whatever is still good and pick up more while it's on sale. The majority of my stock portfolio is about 80% SP 500 plus total market fund. Another 10% is in international funds, and the last 10% is some combination of cash equivalents, some bonds, and maybe less than 5% is going to be some higher risk things that I try here and there. So One thing that I'm doing is I've bought call options in TLT. This is basically a 20 plus year bonds for the US. And I got call options 1 to 2 years out. So for this, here's an example. It was for January of 2027. So for this, I pay a $3 premium per share for this option. And that effectively is multiplied by 100 shares within an options contract. So that means it's $300 to buy one of these. I picked a $110 strike price for January 2027. If the value goes up above $110 a share, I can either buy the shares at $110 regardless of what the price is at that point. So if it goes to 120, 130, basically I make the difference between that times 100. The other thing that I could do is sell the option. So I tend to do that a lot more often because what I could do is sell the option for almost the amount of profit that I would have gotten anyway, maybe a week out or 2 weeks out or something like that. Whenever it goes above $110 a share, I'm going to be looking to sell that option. So why did I take this position? Well, bonds are inversely proportional to interest rates. So let's come over here. So if interest rates are 5%, let's just assume this is, I get $100, which is the bond face value in a year. I know these are not 1 year bonds, but this makes math easy. And the current value that I pay would be $95 because I need to make 5% roughly to get to the $100. Now, let's say during a recession, the Fed then needs to drop its interest rates to help stimulate the economy. Why would they do that? Well, they have a dual mandate that they need to keep stable prices, approximately a target of 2%, and they want to achieve maximum employment. So if they see people starting to lose their jobs and things like that, they need to reduce interest rates, do some quantitative easing, things like that. So that happened back in 2007 through 2009. It also happened starting in 2019 and was accelerated in 2020. If you take a look at the chart, basically you can see when these dip. You can also see when TLT spikes. So what I'm looking for is if we hit a recession before January of 2027, I would anticipate the Fed dropping interest rates, thereby increasing the value of bonds because they're inversely proportional to the interest rates coming back here. So what happens if I bought this bond and effectively it was $95 back here when it was 5% interest? And what would happen if they dropped the interest rate to say like 0% as they did in 2020 and 2019 roughly? Well, the current value would then be brought up to $100 because there's pretty much no interest because you're going to get paid $100. So overnight, that $95 bond value could shoot up to very close to whatever the face value is. I really like bonds, but only when I think the interest rates are going to significantly drop. I do not like bonds when I see interest rates rising. So that's why I haven't been holding a lot of bonds over the last couple of years when interest rates were rising. Even higher risk, and this is held for an even shorter period of time, these are speculative. I'm only going to hold this for a couple of days. I sold some of this off. I bought UVXY at $21 a share. I sold some of it off at about $25 to $27 a share. I bought it back at $23 a share. This basically follows the VIX. The VIX is an estimate of like a fear index, and I've used this successfully in February and March of 2020 when basically the illness was spreading around the world, and I used a trailing stop so that this is kind of like juggling knives. It goes up very quick, and just as quick as it goes up, it comes crashing down. So I use a trailing stop, maybe 20 or 30%, so that if it starts to drop significantly, it automatically triggers the market sale, and I don't have to sit at a computer watching this because I have a full-time job. But basically with that, I had a 400% return then. Right now, I've maybe had 20 or so percent return. Depending on what happens over the next couple of days to weeks, this may go up. It may just come back down very rapidly. This is very high risk. I don't like to spend more than a fraction of 1% of my portfolio on something like this. Generally, when the VIX is low, I can buy SPY put options and buy those maybe 6 to 12 months out. And this effectively acts as downside protection, or what you can think of as insurance. What a put option allows me to do when I buy it is effectively I could pick a strike price for the S&P 500. Basically, if this price goes below whatever that strike price is, I can ensure that I'll at least get that strike price for 100 shares. If the value of the SPY goes below whatever the strike price is, I can effectively put or have it sold to somebody at a guaranteed price, regardless of how much further it drops, at least for the 100 shares that are covered by the option. Or I could sell off the put option at that point and make money there and still hold on to my stocks. So those are a couple of different ways I do that. So it reduces that overall risk of loss, but it also reduces your overall return because you're paying some premium for the contract. So that's going to take away some of the value. So your Vega, when VIX is high, is basically your volatility. When volatility is high, your options, contracts, and premiums cost more. When the VIX is very high, that's when I like to sell options. When the VIX is low, I like to buy options, just because there's a volatility component in the pricing of an option. I have a video on options trading. You can see that as well on the channel. So even though we've lost 10% in the stock market, I don't know how much further it's actually going to go. It may have bottomed out. Who knows? Only time will tell. So even though we've had a market downturn, I'm not really changing my strategy. Basically, when I'm investing, I'm buying and holding for a long period of time, so I just see this as being on sale. So I'm still buying the S&P 500. I still invested about $10,000 over the last week, 80% in the S&P 500, about 10% in international stocks, and about 7 or 8% in cash equivalents, and maybe a fraction of 1% in this and a fraction of 1% in TLT. But these are high risk, speculative, and I'm not going to bet a lot of money on that because this is basically gambling. Whereas the S&P 500 and international like ETFs and low cost ETFs, that's more of an investment. That's a long-term thing. Whereas this is holding a day, holding a week, and who knows if they go up and down. If you found this useful, please subscribe. I cover a lot of financial topics such as how to make more money, how to save, how to invest, and how to start your own businesses. So if that interests you, please subscribe and have a great day.